Money at Work continuing education series. Today we're talking about bear markets. What should you really know about a bear market so that you can act accordingly to prepare, act accordingly during, and act accordingly post bear markets? So, what exactly is a bear market? Well, a bear market is going to be a 20% drop. So market cycles are measured from peak to valley or peak to trough, however you want to classify it. So a stock index, a asset class, or an individual stock officially reaches bear territory when the closing price drops at least 20% from the recent high. Now, in between that, from about 10% to just under 20%, is classified as a correction. And then a new bull market begins when the closing price gains 20% from the low. Next up is that stocks lose, an average of about 36% in a bear market. So that sounds like a lot, and it is a lot. Remember, Warren Buffett has two rules for investing. Number one, don't lose money. Number two, don't forget rule number one. However, in contrast, stocks gain 114% on average during a bull market. Bear markets are normal. There have been 26 bear markets in the S&P 500 index since 1928. However, there have also been 27 bull markets. So there's that constant tug of war between the bear market and the bull markets. And if you look at over the long term, stocks have risen significantly. Bear markets tend to be short-lived. The average bear market is about a little bit over 9.5 months. That's significantly shorter than the average length of the bull market, which is over 2.5 years long. A bear market does not necessarily indicate economic recession. There have been 26 bull markets since 1928, but only 15 recessions during that time. Bear markets often go hand in hand with a slowing economy, but declining market does not necessarily correlate and mean that a recession is looming. And then bear markets can be painful, obviously, but overall, markets are positive a majority of the time. Over the last 92 years of market history, bear markets have been comprised only about 20, a little bit over 20 of those years. Put in another way, stocks have been on the rise, close to 80% of that time. So yes, bear markets happen. Bear markets are not fun. We don't want to lose money. But if you look at it another way, bear markets make people a lot of money. They just don't know it at the time. Remember, great companies go on sale sometimes with the macro trend of the market heading lower. You have to realize that coming out of those bear markets, those great companies that were unnecessarily discounted are going to perform the best when the market does turn and go into another bull cycle. MillionaireMindset.life, stretch your thinking, create your vision, and achieve.